The CNIB National Youth Council presents Let's Talk Money. Part 5, First Time Home Buying.
Thanks everyone for joining. Today we'll just go over a few home buying questions. We'll go over some marketing or housing market updates and things like that. So, and then what it means to work with a mortgage specialist, and what you need to know about when you are starting to do your home buying process. So we'll get to the next screen here, or the third screen. So that's what we're going to cover. Next one, please. So working with a mortgage specialist. So when we're looking at purchasing a home, the most important part is to see how much we can qualify for, or can we qualify at this time? Do we need to wait for certain things? And we'll cover all of that today. So the first step always is to make sure that you are aware of how much you can be eligible to buy. What is your purchase power? So that means how much of a home can I purchase for based on my income. So when I'm working, we take your gross income and we use that plus all of the debt obligations that you have on a monthly basis, and we come up with something called the total debt servicing ratio. So that's a formula that banks use to find out how much you're eligible for to qualify on your for your purchase. So pre-approval is the first step to start when you're looking for a home. Your real estate agent or your builder, anybody you go into, they will ask you for a pre-approval. The pre-approval consists of doing a credit check. So we do a credit check for you. We do collect your income documents. We do discover to see if you have down payment. In Canada, minimum down payment requirement is 5%. So anybody that's looking to purchase a home in Canada, whether you're a first-time home buyer or second-time home buyer, you're always going to need 5% down payment. And that's based on the purchase price of the home. So if your purchase price is $300,000, you're going to need $15,000 at least that's been in your account for the last 90 days. Now, there are different ways you can, there are different programs that we do have where you can get gifted down payment for your down payment from a family member, mom, dad, brother, sister, grandparents, cousins, anybody like that who's willing on helping you with the gifted funds. Then we do have something where you can use your RRSP, so Registered Retirement Savings Plan. With the RRSP, you're allowed to take up to $35,000 that's already been in that account under the first-time home buyers plan. So that's another way of using your down payment. Then the last or the third one we have is the government program that they introduced about a year and a half ago, where you still need to have the first 5% down payment from your own pocket, but the rest can be given from the government. Now, there are different policies and process for that program, which is a different topic. There are qualifications that you have to meet. There are criteria that you have to meet for that program, but your minimum down payment must be 5% with that program as well. So that's the first step. So we're going to look at your income, we're going to look at your credit, and we're going to look at your down payment. So once we have those three figured out, then we'll start your pre-approval. With the pre-approval, we punch in your income, your gross income. When we do your credit check, it's going to tell us what are your monthly payments on your car loans, your line of credit, your credit card balance, anything like that. So it's going to ask for it's going to give us all of that information. It's also going to give us a score, your credit score. So a credit score is very important to make sure that we maintain those payments on a regular basis. You're making payments on everything on a timely manner. You're also not going all the way up to your credit limit. So those are some things that we look at when we're doing your credit check. So once we punch in everything into our system will automatically give us an idea of, based on our experience, we'll be able to tell you how much of a home you can purchase. Once our system has given us an amount that you are qualified for, we will then give you a a pre-approval letter, which you can then take to your real estate agent or your builder. And that's when the fun part starts and you can start shopping for your home. So that's the first step of the mortgage process. So pre-approval. Now, when you are working with a mortgage specialist, we're going to offer, after the pre-approval, you've looked for homes, now you have placed an offer, we look at giving you firm approval. Firm approval is a guaranteed approval. Working with a mortgage specialist, you're also going to have our experience, you get our direct line, you get access to having our direct lines where you can make contact with us even after the normal business hours. We understand that not everybody works a 9-to-5 job, and hours vary. So we are available to our clients even after the norm hours. So that's kind of what we look at when we're doing your pre-approval. So then the next step, or we'll move on to the next slide here. So some of these ways, some smart ways. And next, so this is a little bit more of a more going into home equity and things like that, but we'll stick with the basics for now. With the first time home buyer, so once we look at your pre-approval, couple of things that you have to think about when you're now deciding on which type of mortgage works best for you and suits your needs. So when you may have heard that the 5-year fixed closed or fixed closed, variable closed, some of those terms may have come across from family members or friends who have purchased in the past. Now, when we're deciding on which mortgage works best for us, we need to look at not only the interest rate. I completely understand the interest rate plays a huge role in your payments, but you want to make sure that the term works for you. Okay, if it's a 1-year term, 2-year term, or it's a 5-year term, do you see yourself living in this home for the next 2 years, 3 years, or 5 years? And is this interest rate going to work for me for the next 5 years? Or am I going to sell it prior to that 5 years? So those are some things to look at. Now, the two different types of terms that we have, not just with RBC, but any bank, we have a variable and a fixed. Now, what those terms mean, a fixed mortgage means that the interest rate that we give you today will be the same interest rate that you have for the term that you have selected. So just like a phone bill, if you are going to sign a contract with a phone company for 2 years, you're locked in there for that monthly premium for the next 2 years. So same thing with a mortgage. If you're going to take a fixed term, your interest rate will remain the same for the next 5 years or 2 years, whichever term that you've selected. It's not going to change depending on the market conditions. If the markets go up, your interest rate stays the same. If markets go down in rates, the interest rate remains the same. So that's on a fixed mortgage. Now, the variable mortgage, it does fluctuate with the Bank of Canada interest rate called prime. Now, prime is based on what's happening in the markets all over. It's Canada, the market, in the world, whatever is happening, and it's based, and it can change annually, it can change every few years, depends on what's happening out in the market. So with that, your interest, your payment will remain the same throughout the term, but what's going towards the interest and principal will change. So that is the difference between the variable and the fixed. A lot of clients prefer the fixed because they don't have time to keep an eye out on what's happening out in the market. With the variable, you can always convert it to a fixed, but you do have to keep an eye out on what's happening in the market so you're aware of any fluctuation on interest rate, because if Bank of Canada increases their rate, what's going towards the interest can also change, and what's going towards principal can also change. So it can take a little bit longer to pay off your mortgage, but more experienced buyers may want to take that risk and go with a variable mortgage. So that's the two different types of terms. Then we also have open and closed. So what that means is, again, you may have heard variable closed or fixed closed, fixed open, things like that. The difference between those two is on an open mortgage, we're able to pay as much of the mortgage off as we can. There's no restrictions, there's no penalties on what we can pay and what we can't pay. It's basically just as you go, as you please. Whatever is available to you, you have extra money, you can pluck that on the principal, and that will reduce your interest over the long run. It won't decrease the balance right away, but when it comes time for renewal, that's when you'll notice the difference. Now, with a closed mortgage, the banks do put on a restriction on how fast you can pay off the mortgage. Now, with a closed mortgage, there's few different ways that the bank will allow you to put extra towards a mortgage. There's lump sum, anniversary lump sum payments that you're able to do. So if you have extra money, you're allowed to put that towards the balance of the principal of the mortgage. Then they allow double up payments. They allow 10% payment increase. And they also allow different types of payment schedules, such as biweekly accelerated, weekly accelerated. Those are a few options that you have to pay off the mortgage faster on a closed mortgage. Does anybody have any questions so far?
I have a question. This is Danica.
Sure.
I guess, why would someone choose a closed versus an open? It sounds like, the way you described it, I feel like open sounds a bit more enticing. You have more of that flexibility. So why would closed be more attractive, let's say?
Yes, great question. Because the interest rate, because the bank is giving you flexibility on how fast you can pay it off, the bank will charge you a much higher rate. So the chances of you wanting to go with a fixed open mortgage, your interest rate difference is almost 2.5% higher on an open mortgage versus your closed. So your payment will be a little bit higher as well on the open mortgage, opposed to the fixed or the closed mortgage. So that's the difference. A lot of people will not take a 5% mortgage when they can get a 2.24% mortgage.
Interesting. Thank you.
Yeah, absolutely. Any other questions?
Yeah, I have another question just to add on to that one. So is there a certain amount of years where if you pay, where like you draw the line between the closed mortgage being cheaper than the variable mortgage? Like kind of like as a rule of thumb?
Yeah, it all depends on the market conditions, right? Like we've had years where we were offering really low variable rate mortgages, and that's all clients wanted, because the interest rates on a variable mortgage were so attractive opposed to the fixed mortgage, because the fixed interest rate was a little bit higher. Like right now, the way things are, a lot of clients are going with a fixed because they feel like with market conditions, interest rates are increasing. So they want to make sure that they're not facing any increase or any changes in their interest. So it all comes down to the client preference. If it was for myself and I wasn't in the banking industry and didn't really care on what's happening with the markets, I would probably go with a fixed, because I know that I don't need to worry about what's happening for the next 5 years with rates. I know this is what's going towards my principal and interest each month, and I'm good. But if you're more of an experienced and you watch the market, maybe the variable is the way to go, because the variable is lower right now opposed to the fixed. But with the variable, clients also feel like they have to keep an eye out on what's happening with the rates, even though with the variable mortgage, you can convert it to a fixed at any time. And right now, our variable rate mortgages are cheaper than the fixed, but it comes down to the client's risk factor.
Okay, great. Thank you.
Yeah, absolutely.
It's Alice. I have a question.
Sure.
If I may. Once your term is up, whether you choose 1 year, 2 years, or 5 years, you have an opportunity to then change the next type of mortgage that you have. If you chose open the first time, you could change it in your next 5-year term.
Absolutely. So that's called a renewal. So that's when when your mortgage is going to come up for renewal. So if you take a 1 year fixed close today, and after 1 year, you're like, you know what? I'm probably going to renew it for a variable closed, a 5-year variable closed, because that's my plan is to stay in this home for the next 5 years. Then you can renew it for a 5-year variable closed, or you can pick lower, or you can do a 1-year term. So you can change it after the term does mature. If you do it before that, there will be a penalty involved because you've signed a contract with the bank that we're going to be with you for the next certain amount of years that we've signed for.
Right. Okay. Thank you.
Yeah, absolutely. And once the mortgage does come up for renewal, it's your choice. You can sell your home, you can renew it again. And at that time, the bank is not going to charge you a penalty because your contract is over with them. So if you wanted to, you can, there are options at that time with whatever you want to do. Yeah. Perfect. Awesome. Great questions. So we'll keep moving on. Now, so that's the two different types of terms. So we've got the variable closed, fixed open, variable open, things like that. So it'll always be those two together. It'll never be just, it's never variable fixed. It's always variable closed or variable open, or fixed closed or fixed open. So two things to keep in mind. Now that's the term. So that's the life of the interest rate that you have. Now the other aspect to that is the amortization. So the amortization plays a role in the life of the mortgage. How long is it going to take you to pay off this mortgage? Now, the banks did change some of those amortization policies and things like that so many years ago. Before, we were allowed to have up to 40-year mortgages, but now they've only given us two options, and that is a 25-year mortgage or a 30-year mortgage. So whichever one you kind of select. So if you are putting down 5% or 10% or 15% or 20 or 19.99%, then you'll only be able to get a 25-year mortgage, because we're going through a default insurance companies, and I'll get into default insurance company after and what that means for anybody purchasing a home. So 25-year mortgage is for anybody putting under 20% down payment, or if you're choosing to go with a 25-year mortgage and under. Now, when clients want to put down a higher down payment, more than or 20% or higher, your eligibility goes up to 30-year amortization. So this is how long it will take you to pay off your mortgage if you stuck with the same payments every month and you didn't put any extra payments towards the principal. So those are the amortization. That's the life of the mortgage. Now, when clients are putting down payments, let's say, for example, we'll go with a 5% down payment. It's your first time purchasing a home. You've got 5% sitting in your RSP. You're looking at purchasing a home for $300,000. You're going to be putting $15,000 of it towards the down payment. Now, anybody buying a home in Canada with a 5% down payment has to go through default insurance. Default insurance, there's 3 different default insurance companies that we have in Canada. One, CMHC, so Canada Mortgage Housing Corporation, Genworth, who have recently just changed their name to Sagen, and third is Canada Guarantee. So all 3 of those companies have the ability to approve you, and they also have their own different criteria that they look at when they're approving the client. So in this scenario, clients, a first-time home buyer, 5% down payment, RSP for their down payment, purpose of funds or that. Now they're going to be paying the default insurance company insurance for the amount. So their insurance premium is based on the purchase price and the down payment. Now there is information when you can Google about these companies. So CMHC, Genworth, and Canada Guarantee, all 3 of them have the same premiums. And each premium, there's a different premium on each stage of the down payment. So 5%, it's usually typically at 4% of the purchase price is your premium. Then it reduces at 10% down payment. Then when you do 15%, then it reduces a little bit more. And if you do 20%, then there's no premium at all on your purchase or on your mortgage. So in this case, when we're looking at a $300,000 purchase, your CMHC premium works out to be about $12,000, and that goes towards the mortgage. So it gets added onto your mortgage. So when you're making those payments, so we're going to go $300,000 minus your down payment of $15,000 plus your $12,000 CMHC fee brings your mortgage to $297,000. So that's what you're going to be making payments on, is the $297,000. You can either do it monthly, you can do it biweekly, but that's how that's going to work. Any purchase, doesn't matter if you're putting down 19.99, you're still going to go through one of those insurance companies. And they look at the same thing as the banks look at: your credit, your income, your affordability based on all of your other debt, and they look at your credit. So they're going to look at all of, and your down payment. So they'll look at all of those different criteria when they're approving you as a client. So you're going to be going through two different companies. So the bank that you deal with plus the insurance company, they both have to approve you in order for you to purchase a home in Canada with under 20% down payment. Now, when a client wants to put down 20%, again, we'll go with the example 300,000. Your down payment works out to be 60,000. It can be gifted from a family member, or it can be saved up, or it can come from your RSP, things like that. So that's called a conventional mortgage. So anybody purchasing a home with 20% or more goes through no insurance companies, and it's called conventional financing. When a client is putting down under 20%, then it's called a high ratio mortgage, or also a default insured mortgage. So that's kind of what those two different types of mortgages are. Now there are different programs, which, that's a little bit more topic for different days, and you guys can contact me if you have any questions after the fact. But as a first-time home buyer, main things to keep in mind is not only is it going to be the bank that's going to approve you, but one of the insurance companies will also have to approve you. We need to make sure that you can qualify, you fit within their criteria, your credit score is a certain score, and they'll look at all of that. So that's the basics there. And I think there was a question that popped up probably on this, but I lost the question. I can't see it anymore. So does anybody, Nibal or Alice, do you want to?
Yeah.
I also have, oh, sorry, go ahead, Alice.
Oh, sorry. The question on the chat is, how will mortgages affect owning more than one house or selling early?
Yeah, so a client can own up to have five mortgages under their name, as long as you can qualify. We do have a lot of clients who put houses up for rent, and we use rental income to offset some of those mortgages, but the criteria is different. Now we're not just trying to qualify you for one home. We need to qualify you for the home plus the expenses such as property tax and heating. Those are the two main things that we calculate in our calculation when we're looking at doing a mortgage application. So we're going to look at all of the properties. If they have mortgages on them, we're going to include all of the property expenses, the mortgage payments, and then if there's rental income that you're declaring, then we'll use the rental income to offset some of those mortgages. But we do still look at your income and what you do for a living in order for us to qualify you. And the down payment requirement does change when a client is looking at an investment property opposed to a principal residence. So the minimum down payment requirements for an investment property do go up to 20% minimum in order for us to qualify you under our investment program. And if you are looking at selling your home before the term expires, there is a penalty, and there's a calculator that the banks use to figure out what your penalty is. And there's two different types of prepayment penalty charges the bank can charge you. It's 3 months of interest or interest rate differential, whichever one is greater. And how we calculate that is how many years do you have left on your mortgage, what's happening with the interest rates at the time that you're looking at selling, and what interest rate do you have. And those are some things that we look at when we're trying to find out what your penalty will be. And so yeah, that's kind of, you can sell prior to, but there is a penalty that is involved unless you are to purchase another home with the same bank within 90 days, within 3 months from each other. That's called a port, and you're able to do that anywhere in Canada. So if you're out in Ontario, or you're looking at moving out into British Columbia or Alberta, a different province, with RBC, you can take your mortgage anywhere in Canada as long as you port, and you'll always get the same service, same advice, same products anywhere in any province. I hope
I have
that
an
answers the
additional
question.
question.
Yeah, thank you so much.
My question is, you mentioned that you need to be approved by both the bank and the insurer. Usually,
Yes.
if you get approved by one, does that mean you get approved by the other? Is there rare, is it often that people
No.
get unapproved from one or the other?
Yes, it can happen, because now, let's say, so typically if your credit is good and your credit score is high, if your beacon score is, let's say, 700, for example, and your income is good, we've got a gross income, we've got all of the income document verification, it's a pretty easy, simple, your debt servicing ratios are in line, then chances are you're going to be approved by the bank plus the insurance company. Now, there are times when the bank approves you, but the insurance company doesn't like something. Now, it can be because you're either a newcomer to Canada and you don't fall under their guideline. So though that can be something, or they don't like the fact, or if somebody's credit isn't good in the past and they don't like the issues that you've had on your credit, maybe you need some more time to reevaluate, get your credit score higher, then they may not approve. So yes, it does happen. But that's what we prepare our clients at the pre-approval stage, is based on our experience. How is it that we can help you become homeowners so there's no surprises once you do find your property? And that's our goal at the pre-approval stage, is to check your credit, check income, make sure that we are aware of what the insurance companies are looking for. So we do have different programs for clients who are newcomers to Canada, maybe have no income but higher down payment, things like that. So we do have different programs, whether you're self-employed, you're not an employee for someone, but you have your own business. There are different programs and different policies that we look at.
Awesome, thank you.
No problem. Perfect. Okay, so that is for the I believe we just covered the CMHC and the insurance company, things like that. So now, after we've done your pre-approval, we will give you a pre-approval letter. With the pre-approval letter, it's based on our experience and based on everything that you've provided to us. So documents, all of that stuff. Once you have that pre-approval letter, now when you start, you're going to want to start shopping for a home. You can use a real estate agent, or you can use or if you're looking at building a new home through a builder, you can go into a show home and provide them with that approval letter. That's when they'll start taking you a little bit more serious and be like, okay, this client is pre-approved, the bank has done their due diligence, make sure that they're good to go. At that time, now if I've given you a pre-approval amount for $500,000 that you're eligible for based on everything that we look at, you can now place an offer. Once you find the home that you love, you place an offer. And if your offer gets accepted by the realtor or the area sales manager, you will sign a purchase contract with them. With the purchase contract, you will typically review, make sure everything's good. You've agreed on a price for the home and everybody's happy. You'll sign a contract with them. That contract now says, it's a legal contract. It basically says you're looking at purchasing this home, and this is your purchase price, and this is your possession date. And then there's usually two conditions that they put into the contract: financing condition and a home inspection if it's an existing property or a pre-owned property. So financing condition, what that means is the builder or the realtor is giving us typically 10 business days to get financing in place for you. Yes, we've done the pre-approval, but now it's time to send off your file along with all of the documents for a firm approval. And that's when the bank will look at review everything, plus the insurance companies. If you have 20% down payment, then it's only the bank reviewing your file. It's not the insurance company. So they're going to look at that. They're going to do all of their checks, make sure everything looks good. Then now we have an approval. Now it's called a firm approval. With a firm approval, we give you another letter saying, yes, you're guaranteed, you have an approval, here's your approval. We're not going to take that approval back from you, even if something changes financially. And that's a Royal Bank policy that we have, or that we offer our clients. A service that we offer our clients is a firm approval. So if anything changes financially, you're guaranteed to still move into that home. Let's say, God forbid, you lose your job, or now you've purchased a new vehicle, and you have a vehicle payment that we didn't include into your approval, but you can still move into your home because we've given you a firm approval. So that's an advantage of working with RBC, is we will give you a firm approval. Let's say you're purchasing a home through a builder. It's a custom home. It's going to take you 9 months to build, and we've given you a firm approval. Same thing applies. Once we give you a firm approval, we hold that approval for you for up to the 9-month period that you're in construction. So that's kind of how that works. So that's a firm approval. Now that you've received a firm approval, you're going to remove those conditions. Financing condition is going to be removed with the approval from the bank. Your home inspection will be removed once you've done a home inspection with your realtor or your builder, and you're good with everything that comes through that property. If everything looks good, great, you're going to sign your home inspection condition and waive that as well. So now that we've done those waives, or we've waived all those conditions, we've received a firm approval, the bank, your mortgage specialist and client will sit down, review everything that they've just approved for you, make sure your payments are kind of within, look good to you, you're happy with the payment schedule, you're happy with the amounts, everything is good. We finalize all of your details, and then we will sign your mortgage documents. Once we sign those mortgage documents, then we will now send your file for the last step of the whole process, which is going to your lawyer to now register the title, transfer the title from the seller to now the new buyer yourself, or from the builder to yourself. And that's when your lawyer will handle all of that. So we, as at the bank, once we've received our signatures on the mortgage documents, we will send everything over to the lawyer. They'll do all of their legal stuff, and then once you sign with them, the day of possession, you get your keys to your new home. So that's the whole process in purchasing your home. Is pre-approval, you start shopping for a home, you place an offer, your offer gets accepted. Now we have a firm approval. After firm approval, we review all your documents, and then we send your file off to the lawyers, and we do the last step. So that's kind of how it all comes down. The best advice I can give anybody is to have all of your ducks in a row before you even consider doing a pre-approval, because that only makes it so much easier and the process to be more enjoyable, opposed to trying to place an offer on a house and you don't even have income documents ready, or you don't even have a pre-approval in ready. So best advice we can provide is, if you do have any questions, approach your mortgage specialist or myself, or go into your bank. Start that process, collect all of your documents that they require, start the pre-approval, and have something in writing so you're good to go, and then you start shopping for your home. So that kind of concludes the basics of that. If there's anything, Nabal, is there anything that you can think of that I might be missing?
Maybe talking a little bit about the credit score piece. What are the minimum requirements for credit score? How can people check their credit score to see if they're on track or not?
Absolutely.
And especially for the insurer, what's the minimum that they're looking for?
Yeah, so the credit score at the bank, we typically are looking for over 600. Some clients will come in with 620. But they've got a high down payment, so it's a little bit of a stronger file. We need to know, why is their credit score so low? Because the minimum requirement for the insurance companies plus the banks typically want to be 680 and higher. But if a client comes in with 660, we're not going to turn them down we need to know what is causing their credit score to be a little bit lower. Was it late payments? Was it a collection item? Was there something that happened? Maybe they're maxed out on their credit and they just need to make those payments, because your credit score does update every 30 days. And how you can find out about your credit, there are two credit companies in Canada, TransUnion and Equifax. You have access to their information. If you Google them, you can actually get in touch with them and find out what your credit score is. And you can ask them how you can make it better, but you do have access to it. And there's an app I've heard a lot about, Credit Karma, you can download, and then it just sends it right to your phone. And you can kind of keep your eye out for the credit score. And then with RBC, we do also have, when you do have online banking with RBC, you are able to look at your credit score as well. And the insurance companies are looking at the same thing. They want to make sure your credit score is around 680 and higher. The stronger or the higher your credit score, the more maximum debt servicing ratio that we can go up to. And those debt servicing ratio, called total debt servicing ratio and gross debt servicing ratio, great information to Google if you are looking for that more in detail. Your maximum score or your ratios have to be 44 to 39, but your credit score plays a huge role in the maximum that we can push it up to. So those are the max that we can push, 44 and 39%. But your credit score, if it's not so low, if it's low, then I can't get you to the maximum. So that means we need to reduce your purchase price or increase your down payment, or we need higher income to support your total debts, your total obligations on a monthly basis to your income and the purchase price. So that's kind of how that works. Yeah, does that cover that there, Nabal?
Yeah, absolutely.
Okay, perfect.
Question, sort of.
Yeah.
Talk. So say you're sort of shopping around for a mortgage and you're going to different banks and they're checking your credit score. Does that affect your credit score in the long run as well?
Yes, it will. So what we usually advise our clients, we get lots of clients just wanting to go to different banks to see what the rate is, for example. And we always advise, if you're just shopping for a rate, just have a conversation about the rate. Don't go in there asking to do a pre-approval, because each bank wants their own credit bureau. So they will pull their own bureaus, and in the long run, it will lower your score. Typically, it can go lower, 10 to 30 points each time you look. So you can only imagine if you're going to bank to see, it will lower. It won't stay low. It will increase the next month because it does update everything through 30 days. But we don't advise, and it doesn't look good because each time you get your credit checked, it does report on your bureau, and we can see that you've been to each bank or you've gone to different grantor for credit, and it only makes the banks look like the clients are credit seeker, and it's not it's not a look that you want for sure when you're applying for a mortgage.
Okay, so it sounds like you can kind of go around just asking about the rates and not necessarily need a pre-approval, and then you're
exactly fine. Yeah. Once you're satisfied with a rate at certain bank, that's when I would advise to do a pre-approval there. And the pre-approval is good. The rate that we quote you is good for 120 days. So if you do a pre-approval today, but you're not ready to move into your home till middle of June, your rate will be valid for 120 days from the start of the application, and your credit bureau is valid for 60 days. After 60 days, it will expire, and we will need to do a new credit check.
Okay, thank you. I have another question as well.
Yeah.
Say it's a young couple going in for their first time home buyers, and one of the partners, their financial situation is a bit more bleak, we'll say, whereas the other partner is more well off. Is there ever an advantage to just getting like the person who's more well off, seeing what they're approved for as opposed to what they'd be approved for together?
Yeah, absolutely. So when we do a pre-approval, if I feel like one spouse has a high credit score and great income, no debt, and the other one has not so great of credit score, a little bit more in debt, and not too high of income, then we may recommend, hey, you know what, we might take this person off and just keep the application under one client. That way we can get you an approval. You can still move into your home, and then you can add the other partner onto the title of the home, and it doesn't have to be on the mortgage. So yes, it is allowed to do that. We're allowed to do that.
Okay, thank you.
Yeah.
I have
Any
a
other-
question as well.
Yeah.
So let's just say like someone that's like, let's say my age, for example, was going to buy a house.
Mhm.
How likely are they to get a mortgage? Let's say they have just 30 to 40 hour weeks, like a regular worker. They have a good down payment, but how likely is their age? How much of an effect is their age going to have on the fact that they get a mortgage or not?
So when you're 18 and older and you've now have established credit, so let's say you've had your credit card, a phone bill, a car loan, 3 different trades under your name, and you've been paying it for the last 2 years, then you've got strong credit. So yes, the chances are pretty good. But let's say you just graduated, you haven't really opened up any credit accounts under your name, the chances are very slim, because we don't know how good of a repayment you've done on your credit. So that's the whole purpose of the credit, is we want to see in the last year, 12 months to 2 years, how's your credit repayment been? Have you been repaying all the credit grantors every 30 days? Now we can see if you've been 30 days late, we can see if you've been 60 days late, 90 days late, 120 days, or if you've gone to collections, things like that. So not only is it the age, like you have to be 18 and over, but your credit, how long you've had it for will play a role. The longer you've had it, the stronger your application.
And does the length of time you've been at your position have any effect on if you can get a mortgage or not?
Yeah, absolutely. So if you just started your job, but maybe you were going to school for the same job, same field, then in 3 months minimum, we'll look at that. And yes, we may be able to get you an approval, or if it's another scenario could be you're changing job to job, like you're just not at a job for more than 3 months, then that has a negative impact on your application. But if you're changing jobs because you got laid off from the old job and now you're looking at purchasing or buying this home with your new job, we'll look at minimum 3 months. You have to be there at least, because a lot of the companies will give you a 90-day probation window. So we do look at that. But if you've been in the same field and now you're just changing because it's higher income, then that's a different situation.
Great, thank you.
Yeah, absolutely. Any other questions?
Maybe not. Maybe we can wrap it up early tonight.
I had one and then it left me, but it just came back. You mentioned earlier, like if you're putting that 20% down, you don't have the default insurance. Is there ever an advantage if you're putting a minimum 20%, is there an advantage of putting like a 30% or 40%? Like, I'm assuming it'll lower your overall payment in the long run?
Absolutely, yes. So if you automatically, as soon as you put 20% down, automatically you'll be eligible for that 30-year mortgage, and now you're in a conventional product. But if you want to now do another 10%, so make it total 30%, then that just brings down your mortgage balance and your payments will be reduced. So that's all that it's doing.
And obviously,
if you have more money, it's worth putting more down.
Yeah, so there's definitely more advantage. If you've got the extra money, put it towards the down payment. Or maybe what I would recommend is if you've got 30% altogether, put down 20% on the mortgage, but maybe you've got some debt that you should be paying off, then I would recommend, hey, put the 10% to pay off some of those loans, because it might increase your purchasing power. So we just look at your application and we look at, okay, what are your debts opposed to how much down you want to put. It doesn't always necessarily need to be like more you put down, the better. It might be better for you to put 5% down, but pay off a bunch of your loans. So then your monthly debt obligation reduces. So you have more purchasing power, if that makes sense.
Yeah, and I just want to add a little bit to that as well. It really depends on, what your goals are as well, right? So I know in previous session, you might have talked about, retirement planning or, planning for different goals, right? And depending on, how much is the interest rate of the mortgage and what is the potential gain that you're going to have in maybe investing that money instead of using it for for a down payment, right? And that's where, the advice piece will come from. And, Manny would work with many different partners to kind of take a look at the overall picture to see, that extra 10% that you want to put down, is it better to put it on the mortgage or maybe investing it or, whatever that other situation may be. Obviously, the more down you put, the lower, not the lower, but the less interest you're going to be paying over time. But again, you could be making additional payment throughout versus putting 10% down. So, these are all options that you can go through. But obviously, the higher your down payment, the lower your mortgage is. Manny, can you talk a little bit about, when you do put 20% down, what does a Homeline Plan, what is a Homeline Plan and what does it mean? And what are the advantages from it?
Yeah, absolutely. So what Nabal is talking about is when a client puts down 20%, you're going to get a conventional mortgage. So that's the conventional mortgage piece. But then there's another product called Homeline Plan, also known as the Home Equity Line of Credit. Clients are only eligible to receive that product if they have put down 20%, which means they have 20% equity in their home. When you're purchasing a home with 5%, your loan is 95% of the value because 5% you've put from your own pocket. Now, when you're looking at doing the Homeline Plan, 20% of the equity is either you've put towards the down payment from the down payment, or you've been making payments on it for the last so many years, and now you've built this equity. So clients can apply for something called Home Equity Line of Credit. With that line of credit, it basically is a secured line of credit to your property. So you're not only going to have a mortgage, but you're also able to have a line of credit on the property. With RBC, our product is called Homeline Plan, where it gives you 80% loan to value is what your Homeline Plan limit will be. Now you can branch it out to having a mortgage under it. You can have a line of credit under it. How our program works is every time your principal payment goes towards the mortgage, your line of credit will increase. So you're building equity on the property. So you're building equity as your mortgage gets paid off. So for example, if you're purchasing a $400,000 home, you're looking at putting 20% down payment, which gives us 80% of that would be $320,000. So that's your Homeline Plan. Now you can put that in either you can have a $319,000 mortgage and a $1 or $1,000 line of credit. But every time your principal payment reduces on the mortgage, your line of credit will increase. And that's the principal amount that will increase, not the full amount of the mortgage. So that's how the line of credit works. Now, with the government, they have introduced a few years ago, your maximum line of credit limit is 65% loan to value. That's the maximum line of credit that you will ever have, unless the value of your home increases and now you want to reapply and take advantage of a higher amount. That's when you can do that. Again, even then, it's 65% value of the home. Your interest rate on the line of credit is prime, which is the Bank of Canada rate, plus 0.5. So that's how that will work. And it's always going to be the lowest interest rate versus an unsecured line of credit. So that's an advantage. Also, when clients are putting down 20%, we do give them the option of having a Homeline Plan instead of a conventional mortgage. Same kind of term for interest rate, same everything applies on that mortgage segment. It's just you have a different product and it's more sophisticated. It allows you to have up to 10 different segments on how you want to structure that Homeline Plan. If you have available limit on your line of credit, you can use that limit and purchase a vehicle and turn it into a mortgage segment if you wanted to do that. So that's how that Homeline Plan works there. Nibal, is that okay?
Absolutely. Sorry,
Okay.
we may have complicated things, but just
Yeah,
this is an option. If you have
yeah.
more questions, just let us know.
Yes, I was trying to stay away from that because it is a little bit more complex of a product, and it's easier to explain in person when we can draw it out. And all of the information that I'm discussing is available on rbc.com website, so you can go into our mortgage tab and review the different terms, different amortization, the Homeline Plan, home equity line of credit, all of that. It's really good information to go into.
I think you did a good job explaining it, Manny.
Okay.
I have one last question.
Yes, absolutely.
For youth, in your opinion, what's the best way for them to start saving up for a house now?
Say that again, sorry.
For youth, like they're in this call or whatever, how should they start saving up to buy a house in the near future? What would be the best way for them to save?
Yeah. So what I would recommend is visit your banking advisor, financial advisor, and let them know what is your goal plan. So how many years down the road do you see yourself purchasing a home? If you know, okay, 5% down payment is the minimum down payment. Your budget is right around that 300,000 mark. You know you need $15,000 for the minimum down payment. Now, we have different options. You can have a tax-free savings account. You can open up an RSP, which is a retirement savings plan, or a basic savings plan or a basic checking account. And you can start putting it on a monthly basis, so it can be directly debited out of your paycheck. Or if you've got some extra money here and there, you can start putting that money away. When you are putting it into an investment, you do earn a return from the bank. So depending on how long you keep the money in those accounts, you will receive some sort of interest, and that will also go towards your money that you've put away. So you can do weekly contributions, you can do monthly, semi-monthly, however you prefer, but that's kind of how we would recommend it, is to start small. It can be $25 every month or $50 or $100 every month, but it will slowly add up, and that can be used towards your down payment. Now, when it comes to the RRSP, I want to make it very clear you are allowed to use that as a first-time home buyer. Your maximum amount that you're allowed to borrow, when people say borrow, that's your money that you've contributed that you can withdraw. Maximum is $35,000. You do need to pay that money back to the government, and you have 15 years to pay it back after you've taken it out.
Is there any interest when you're paying that back?
No, there's no charge to the interest or to the government. You just set up a payment plan with them. And then if you want to pay it all off in one shot, you can do that. If you want to do it in monthly payments, you can do that. So it's completely set up through the government.
Okay, cool. Well, I'm just keeping an eye on time, and we're about at the hour mark. So if it's okay with everyone, I'm going to wrap it up. I want to say a great big thank you to Nabal and Manny for being here. I think it's pretty neat how we started off our series with RBC, and now we're full circle and we're ending it with you guys again. So it was great to be able to partner with you guys in this series. And it's been a great 12 weeks. We've learned so much, and even just tonight, I know I've definitely learned more than a thing or two. It was very informative. And I'm going to pass it over to Caleb if there's anything else he wants to say to wrap this up.
Yeah, I just want to say big thanks to RBC. Like you said, started with RBC, wrapped it up with RBC, and Bob being our one and only 2 presentation speaker. So that was cool. Yeah, personally, I'm looking around for a house. So this is the session I was really looking forward to, and I think it met and exceeded my expectations. So thank you to you both.
To learn more about the CNIB National Youth Council, visit cnib.ca/NYC.